After completing the module, participants will be able to outline considerations for assessing leakage risks, outline considerations for assessing impacts of carbon pricing across society, describe measures to mitigate leakage and potential adverse effects on segments of society. Within the course of this module, we look at how to assess leakage, distributional impacts, and design measures to mitigate unwanted effects. Carbon taxes are designed to alter the economic costs of certain behaviours that produce greenhouse gas emissions. While they can be expected to reduce emissions and may bring a range of additional benefits, they can potentially also have some unwanted effects. These unwanted effects relate mainly to carbon leakage, international competitiveness, and negative distributional impacts. Negative impacts of carbon taxes can undermine their environmental effectiveness and political longevity if concerns from citizens and firms are not duly anticipated. It is therefore important to understand the nature of the associated risks, how to assess their probability of materializing, and how to create an effective policy to address them. Against this background, in this section we start off by responding to 6 questions related to the risk of leakage. What is carbon leakage? How is carbon leakage distinct from competitiveness concerns? How does leakage occur? What is the evidence on leakage? How can leakage risks be modelled? What measures can be taken to mitigate identified risks? Carbon leakage occurs when an emission reduction policy, such as a carbon tax, inadvertently causes an increase in emissions in other jurisdictions that do not have equivalent policies. Leakage can also lead to a reduction in emissions in other jurisdictions, although this is not common. For example, when a carbon tax spurs innovation in the taxing jurisdiction through the deployment of new technologies, other jurisdictions might adopt these practices themselves. Through such technology spillovers, emission reductions can take place in areas with no active carbon pricing measures. Leakage and loss of international competitiveness are often closely related. As a matter of fact, some overlap exists between the risks associated with the two phenomena. Nonetheless, they are fundamentally distinct concepts. Where leakage relates to the environmental effectiveness of a carbon tax, competitiveness relates to economic impacts. It is therefore important to understand each in terms of the specific factors that shape them. International competitiveness refers to the ability of companies to maintain or increase their international market share. Leakage typically implies shifts in international market shares between firms in different jurisdictions. Where market share moves from firms in one jurisdiction to firms in another jurisdiction with higher average emissions, the environmental effectiveness of the carbon tax is undermined. This is called inefficient carbon leakage. In fact, the pollution merely changes its location. Moreover, losses in market share can also lead to a reduction of jobs in certain industries. This can be politically sensitive, especially when intended emission reductions do not materialize as a result of carbon leakage. By contrast, if increased costs result in a production shift to firms with a lower emission intensity, this is a desirable outcome. As a result, such leakage is considered efficient. It is important for policymakers to distinguish between these two kinds of leakage when devising a leakage mitigation policy. Providing assistance to protect firms that would otherwise lose market share to more efficient firms undermines the environmental effectiveness of the tax. The effects of carbon pricing on competitiveness may differ over time, depending on how agents respond to it. Can you determine which effects are commonly associated with carbon taxes in the short and long term? Match the effects with a corresponding time frame.
Short term, Disadvantage: if firms have not undertaken emissions reductions prior to a carbon tax taking effect, and in the absence of supportive measures, the tax simply implies increased input costs, similar to higher rates on market prices for raw materials. Long-term advantage: in an environment where carbon production is highly valued by virtue of international norms, covered firms enjoy an early mover advantage as they have become accustomed to reducing their carbon intensity.
Analyses suggest there are 4 broad channels through which leakage occurs. Policymakers generally focus on the first 2 channels, as they involve risks that can be mitigated through adopting certain policy measures. Leakage through the fossil fuel price channel is harder to target directly through policy because of the complex determinants of global fossil fuel prices, resulting in a lack of leakage mitigation options. By contrast, reverse leakage is regarded as a co-benefit.
The K channel: output, short-term competitiveness. Higher carbon emission costs cause covered firms to lose market share to those firms not covered by the carbon tax. Investment, long-term competitiveness. Carbon tax leads to reduced investment in maintenance by covered to sustain output levels. Firms shift investment and location of lands to non-taxing jurisdictions. Fossil fuel price: firms in taxing jurisdictions are likely to reduce fossil fuel consumption, which can lower the price of global traded fossil fuels, triggering increased consumption in non-taxing jurisdictions. Technological spillovers: carbon tax spurs innovation in the taxing jurisdiction, leading to the development of more effective technologies that are subsequently adopted in non-taxing jurisdictions.
While the theoretical argument higher carbon taxes equals lower competitiveness equals loss of market share may sound intuitive at first glance, no significant evidence has yet been found of carbon leakage in practice. This is because other business factors and structural conditions in a country are typically far more impactful determinants of competitiveness than carbon pricing. For example, input costs such as energy prices and salary levels tend to be more important. Other factors include labour skills, brand loyalty, and proximity to markets. Furthermore, within a jurisdiction, it is recognised that the quality of infrastructure, institutions, and education levels can be far more significant. Where jurisdictions have reason to believe that a proposed carbon tax may lead to leakage, ex-ante modelling can be useful in testing assumptions and estimating the risks involved. Ex-ante models provide evaluations of proposed new policies, forecast into the future. They generally involve comparison of a with policy and without policy simulation, using a business-as-usual scenario. Basically, 2 types of ex-ante models can be used to assess leakage. 1. Partial equilibrium models, and 2. Computable general equilibrium or CGE models. Partial equilibrium models examine the effects that a carbon tax can be expected to have on particular sectors of the economy. CGE models are large-scale representations designed to capture the interplay among a range of economic forces or the economy as a whole. Where jurisdictions perceive the risks of leakage as significant, they may want to adopt mitigation measures. At the beginning, it is recommended to develop a set of criteria to make the provision of relief measures more transparent and targeted. Two criteria are commonly used. The first is carbon intensity, typically measured as carbon emissions per unit of output, revenue, or similar economic metric. This criterion captures the impact that carbon pricing has on a particular firm or sector. Carbon-intensive industries are more prone to leakage, given that their output costs tend to be higher as a result of carbon taxes. Secondly, trade exposure indicates the extent to which firms are at risk of losing market share as a result of international competition. Greater exposure implies a reduced ability on the part of firms or sectors to pass on costs to consumers without compromising their competitiveness vis-à-vis foreign firms. Trade enables competition between producers and therefore exposes firms subject to a carbon tax to those with less stringent carbon regulation. The way a carbon tax is designed has an important bearing on the potential for carbon leakage. But which economic activities and products pose, by their nature, low leakage risks? Select the right responses.
Which economic activities and products pose a low leakage risk? Where the majority entities affected by a carbon tax are consumers or local service, then energy-intensive or non-trade exposed businesses leakage is unlikely to occur on a significant scale.
In summary, both metrics, carbon intensity and trade exposure, are necessary conditions for there to be a risk of carbon leakage. Once a significant leakage risk is identified, the two criteria also help determine eligibility for assistance to specific economic groups, sectors or companies. Assistance is often separated into tiers depending on the degree of risk. While jurisdictions in practice have focused on the two criteria, other factors may also play a role in the leakage exposure. What are these other factors? Click on the triangles to reveal them. A carbon tax can have significantly differing impacts on different groups in society. Where the carbon tax falls disproportionately on certain groups, and this is not addressed through compensation measures, this can have negative distributional effects. It distributes the cost of the carbon tax in an uneven or unfair way. Therefore, in this section, we examine 5 questions. What are potential impacts on different income groups? How might impacts vary across regions? What is the evidence of such impacts? Can impacts be identified through economic modelling? What are the criteria for determining mitigation measures? A carbon tax may affect one income group more heavily than another. Most often, things like electricity or heating fuel are indispensable. In the absence of support measures that help consumers reduce their use or switch to cleaner alternatives, demand for these goods is inelastic, especially among low-income groups. In developed countries, low-income households tend to spend larger shares of their budgets on energy than the rich. Therefore, where a carbon tax increases energy prices, and this is not compensated by other measures, such as subsidies or rebates, it can hit the poor harder. If this happens, the carbon tax has a regressive effect. The reverse is often true in developing countries, where the rich segment spend a greater share on energy. In the latter case, the carbon tax is considered progressive. A carbon tax may also fall more heavily on certain regions. Considering the following examples, which regions are likely to be more greatly affected as a result of carbon pricing? Click on the arrows as you consider fit. As in the case of leakage risk, ex-ante modelling helps to gauge distributional outcomes. When examining risk through the lens of partial equilibrium or CGE models, the following factors should be taken into account. Click on the triangles to learn more.
Context analysis suggests that carbon taxes are, even without compensation measures, more progressive in developing economies. For example, a modeled carbon tax in China seems to favor low-income households because they use so little fossil fuel. Tax design. The level and coverage of a tax matters. Studies show that a carbon tax in Canada would be progressive at low levels but become regressive at higher levels. In the Netherlands, a broad-house gas tax is expected to be more cost-effective and slightly less regressive than a comparable but narrower tax on carbon alone. Income definition modelers generally use two primary definitions of income: annual income and lifetime income. A hypothetical carbon tax in the United States suggests that the extent of regressivity measured in terms of annual income is twice as high as when measured using lifetime income.
The criteria for determining mitigation measures against expected negative impacts are highly dependent on politics, culture, and capacity. However, the following aspects can guide decision-making. The first is the direction of distribution. Not all distributional impacts are negative. A carbon tax may be progressive in developing economies, falling primarily on high-income households that can afford a substantial energy component in their budget. Notably, a progressive tax may still affect low-income households in a way that justifies the adoption of compensation measures. Secondly, the magnitude of impact matters. Where the costs of a carbon tax are particularly burdensome for low-income households, for example when the tax liability exceeds a certain share of total spending, jurisdictions may be inclined to adopt mitigating measures. In some cases, however, jurisdictions may decide not to mitigate tax regressivity if the magnitude of the regressive effect is relatively small. This is particularly relevant where the economic costs of redistributing income are substantial. At times, the costs will be too high to justify the social benefits of redistributing income. The third aspect is context. In certain cases, uneven impacts on regions may be tolerable, considering the track record of the agents involved. For example, If a disadvantaged region has been slow to adopt available green technologies or has refused to adapt to clear economic signals, the jurisdiction might deem it fair to expect the slow adapters to bear the full cost of their emissions. Where jurisdictions do decide to target mitigation measures at specific groups, they will often define eligibility based on existing categories and definitions. For instance, in Ireland, the Better Energy Warmer Home Scheme includes benefits for job seekers and single-parent families. Which other categories might be used in the context of your jurisdiction? Write them down. If potential unwanted impacts are regarded as significant, policymakers can adopt a variety of measures to support firms and vulnerable sections of society. Policymakers can deploy a single measure or a combination to address multiple needs. The measures can be grouped into two general types of support: those that target leakage and distributional risks on the one side, and those that target leakage only on the other. Among the former, there are measures that reduce the amount of carbon taxes payable, such as reductions and exemptions. Furthermore, there are measures that support taxpayers in adapting to the costs of the carbon tax, such as output-based rebates, support programs and subsidies. Measures targeting leakage only comprise border carbon adjustments, as well as tax coordinating arrangements with other jurisdictions. Click on the highlighted areas to learn more. If policymakers seek to broaden the reach of a carbon tax, they can opt for border carbon adjustments, or BCAs. A range of BCA designs have been proposed, though most commonly they seek to level the playing field between domestic and foreign markets by pricing the carbon content of both imports and exports. For example, if a domestic product is taxed at $2, a comparable imported product would be taxed by the same amount by customs before being allowed to enter the domestic market. The same logic applies to exports. Here, tax rebates or exemptions help ensure that domestic firms do not lose market share in export markets. The level of the BCA would correspond to the carbon tax, ensuring that domestically produced goods are not placed at a disadvantage relative to products from other jurisdictions. Thus, BCAs can achieve equivalent taxation between carbon-intensive products and reduce the risk of leakage. Countries can, in principle, avoid carbon leakage risks by ensuring that key competitor countries adopt similar measures to reduce emissions. There are no examples yet of countries or jurisdictions entering into reciprocity arrangements with regard to carbon tax. Devise effective tax coordination by selecting coherent policies.
Carbon price policy adopted by all countries. A few considerations are crucial. Notably, reciprocity need not involve an identical carbon price policy adopted by all countries. A few considerations are crucial though. One is that the policies across countries result in a similar cost of carbon, regardless whether the cost is generated directly or indirectly. Another consideration is that reciprocity arrangements need to cover a sufficient share of the commodities at risk of leakage in order to be effective.
Jurisdictions can also provide direct support to companies through subsidies or technical assistance programs. These forms of support will often focus on encouraging the adoption of climate-smart technologies that reduce the cost of emission abatement. Thus, in combination with a carbon price, a double incentive for emission reductions is created. Assistance may be targeted at households, as in the case of Ireland's Better Energy Warmer Homes scheme, at businesses, as with Japan's incentives for energy-saving equipment, or at both, as in the case of South Africa's energy efficiency tax credits for both companies and consumers. The government also plays a role in financing green infrastructure, such as public transport, to facilitate behavioural changes of businesses and citizens. One of the most common measures jurisdictions have taken to reduce the effects of the carbon tax on both industries and consumers is recycling the revenue through reductions in other taxes. Such reductions can target the economy as a whole through overall reductions in corporate or labour taxes, as happened in France, or by reducing health and social insurance contributions, as happened in Switzerland. Alternatively, they can more specifically target leakage-exposed sectors or vulnerable groups, such as low-income families, as was done in Portugal. These are direct financial transfers made to households or industry, often using carbon tax revenue. They are not linked to a given action on the part of the taxpayer. These payments can also take the form of rebates received, for example, as part of annual tax returns. Alternatively, assistance could be linked to the estimated additional electricity or heating costs low-income households are expected to face. Every jurisdiction faces the challenge of maximising the environmental effectiveness of a carbon tax while avoiding placing an excessive burden on vulnerable industries. One way to address this challenge is to offer benefits such as rebates or exemptions to companies under the condition of entering into agreements with the government. In Denmark, for example, companies committed in a legally binding manner to reduce their energy use in exchange for rebates. Evidence suggests high compliance rates for this type of approach. The bluntest way to reduce the tax burden of firms is to provide an exemption from tax obligations. Full exemptions completely exclude a company from tax obligations, while partial exemptions allow it to avoid paying tax on a certain portion of its emissions. Jurisdictions can set multiple carbon tax rates, offering lower rates to sectors deemed at risk of leakage. This was the approach initially taken by Sweden, where until recently a two-tier system applied a lower tax rate to energy-intensive and trade-exposed sectors. Jurisdictions sometimes give out rebates to firms based on their level of output and a sectoral emissions benchmark. Essentially, these output-based rebates encourage firms to seek out means to decrease the carbon intensity of their production processes. Suppose a firm produces 100 units of a good at a carbon intensity of 10 tons of CO2 per unit. At a carbon tax rate of $10 per ton, The resulting tax burden would be $10,000. Now, let us imagine that a jurisdiction has set up a rebate scheme using a performance metric, such as a sectoral emissions benchmark. 5 years later, the same firm doubled its production to 200 units. As the firm invested in a series of resource-efficient technologies, it managed to reduce its carbon intensity to 6 tons of CO2 per unit, thus staying below the sectoral emissions benchmark. As a result, the jurisdiction rewards the firm with a rebate, leading to a tax burden that is lower than the nominal $12,000 it would pay without the rebate. This approach has been applied in the context of the Swedish no-X tax, as well as in several emissions trading systems. An alternative means of reducing the tax burden is by permitting liable entities to meet part of their tax obligation through the use of offsets. This can reduce the compliance costs faced by entities while still ensuring the achievement of emission reductions, although the emissions reduced would be in other sectors or countries. However, as in the case of exceptions, this results in reduced revenues. Many jurisdictions, such as South Africa, have set limits for the use of offsets. While reducing costs for liable entities, developing a domestic offset scheme may involve complex design and administration. Alternatively, jurisdictions can use offsets from other schemes, such as the Clean Development Mechanism. As every jurisdiction is different, there is no universal recommendation as to which mitigation measure or measures policymakers should choose. Every measure features distinct pros and cons, which need to be assessed in view of jurisdiction's political, economic, and social circumstances. Developing a set of criteria helps to inform such assessments. The criteria may entail, for instance, a measure's effectiveness in preventing leakage or unwanted distributional effects, the environmental effectiveness by upholding the incentive to reduce emissions, administrative simplicity, and political acceptability. Let's take the example of exemptions and consider how this measure generally fares against these criteria. Keep in mind that actual performance of a measure will depend on context and design. As every jurisdiction is different, there is no universal recommendation as to which mitigation measure or measures policymakers should choose. Every measure features distinct pros and cons, which need to be assessed in view of jurisdiction's political, economic, and social circumstances. Developing a set of criteria helps to inform such assessments. The criteria may entail, for instance, a measure's effectiveness in preventing leakage or unwanted distributional effects, the environmental effectiveness by upholding the incentive to reduce emissions, administrative simplicity, and political acceptability. Let's take the example of exemptions and consider how this measure generally fares against these criteria. Keep in mind that actual performance of a measure will depend on context and design.
The empirical data has severely supported the concerns of jurisdictions that allocate is a serious problem. True, of course. When a carbon tax causes less emissions intensive firms to increase their market share, this isn't positive and intended of the tax. It is difficult to generalize about the distributional impacts of carbon taxes because their effects are highly context-dependent. True or false? True. Clearly, defining eligibility for mitigation measures to address the unwanted effects of carbon taxes avoids which of the following: select all answers. Gross missing the effectiveness of the tax. Hardening public purchase.